Welcome to the latest episode of Quest for Twice. This is my documentation of my quest to earn twice the amount of my nominal salary through investment. I'm excited to record this episode because I just bought a new stock and I want to document my investment thesis. It is an understatement to say that this year is full of ups and downs with the investment and with the stock market. So S&P 500 recently made the all-time high and exceeded the previous peak achieved in February of this year. But if you look under the hood, it's actually a story of two cities. So not all sectors are doing well. For example, on this graph, I showed the S&P 500 stock market performance comparing to the energy sector of the stock market. The top is the black line, and the historical performance in this year. You can see that it peaked in February, then had a big downturn in March, then rebounded and went up from there. And at the end of August, it achieved the all-time high. However, if you look at those two lines, blue and orange, you can see that the energy sector didn't do so well. So it had a big downturn and lost almost two-thirds of its value from the beginning of the year, then rebounded at the beginning of June, then had another leg down. So at the end of August, the energy sector is sitting about 40 to 45% less than its value at the beginning of this year. So those two lines, the orange line is XLE, that is Energy Select Sector ETF. The blue line is AMLP, that's Alerian MLP Infrastructure Index. So they behave quite similarly. And you cannot blame the investors for having very negative sentiment against energy in this year. There were some really bad headlines. For example, Shell and BP cut dividend by two-thirds and one-third in 2020. And Chesapeake Energy entered into bankruptcy protection in June. And prolonged downturn is expected. So as a result, almost all the energy companies are punished significantly, including the midstream companies who own and operate the pipelines. So like all the other energy companies. So how much are they disliked? Recently, I had Morningstar done an analysis of my mutual funds held by me and my wife. So none of my 25 stock mutual funds own Energy Transfer, that's a major midstream company. And only S&P 500 index funds own a very small portion of Kinder Morgan. That's another major midstream company. Whenever a company stock is punished due to guilt by association, there is potential value to be found. So in this case, let's take a close look at the two midstream energy companies. So midstream companies are much less exposed to oil and gas price than oil and gas producers. The reason is simple. The oil price is very sensitive to the imbalance between supply and demand. And because they are generally inelastic, so a small imbalance between supply and demand can cause large swing in oil price and affect the bottom line of oil and gas producers. On the other hand, midstream companies are paid based on the volume of oil and gas going through their pipeline. So a small reduction in the demand, i.e. in the volume of oil and gas going through the pipeline, has a fairly linear impact on the revenue and flowing into the bottom line. For example, the trailing 12-month revenue of two midstream companies, Kinder Morgan and Energy Transfer, had a reduction of 8 to 15% from their 2019 revenue, comparing to 25% drop by EOG or ConocoPhillips. And keep in mind that the trailing 12-month revenue include two good quarters in 2019 and two really bad quarters in 2020. So if we only look at the revenue reduction in 2020, the discrepancies between the oil and gas producers and the midstream companies would be even larger. So let's take a close look at the value evaluations of two midstream companies, Kinder Morgan and Energy Transfer. So a good benchmark is the event that earlier this year, Berkshire Hathaway, the company led by Warren Buffett, spent about $10 billion to buy Dominion natural gas pipeline assets. So he paid about 10 times of the EBITDA of Dominion natural gas pipeline asset. EBITDA is earning before interest, tax, depreciation, and amortization. And look at the Kinder Morgan and the Energy Transfer, their enterprise value over EBITDA is 9.2 and 8.2. So you get a 10 to 20% discount comparing to a good value investor like Warren Buffett. Another aspect is to look closer at the financial information. Kinder Morgan has fewer debt, 39 billion versus 52 billion, but owned by Energy Transfer. And the market cap by Kinder Morgan is larger, 31 versus 17 billion for Energy Transfer. And they both made a forecast of their cash flow from operations in 2020. In this case, those two companies call them DCF, distributable cash flow. And Kinder Morgan has a forecast of 4.5 billion in 2020 versus 5.4 by Energy Transfer. So the DCF is cash generated, and then we need to take a close look at how they use the cash. So the cash will be used. One is for capex, for capital investment. Another is for dividend. And if they have additional cash, it's usually used to pay down debt or buy back shares. So Kinder Morgan had a capital plan for this year and next 2 years at between 1.5 to 1.8 billion dollars. And currently, Kinder Morgan is paying about $2.4 billion dividend each year. And based on the current stock price, that translates into a yield of 7.6%. Compared to Energy Transfer, Energy Transfer this year has a lot capital expenditure planned. That's 3.4, but it'll drop off very quickly to 1.3 billion next year and 0.6 billion the year after. Energy Transfer will pay $3.3 billion of a dividend in this year. So let's do some simple math. for Kinder Morgan, this year's outlay of cash is 1.7 capital plus 2.4 billion dividend. That together is 4.1 billion, and that is less than 4.5 billion of cash generated. So there is a surplus of cash. And for energy transfer, the dividend is 3.3 billion plus 3.4 billion capital planned. That's 6.7 billion, and that's a 1.3 billion more than the cash generated in this year, which is 5.4. So there is a problem. You see, there is a cash shortfall for energy transfer in this year. So how do they fill this gap? And they are going to borrow money. So they need to borrow roughly $1.3 billion to close the cash flow gap. Remember earlier we talked about their debt load. So energy transfer has already quite a lot of debt at 52 billion compared to the debt owned by Kinder Morgan at 39 billion. So energy transfer has to borrow even more money on top of its heavy debt load. So borrowing debt has consequences. So for Kinder Morgan, this year it paid $1.6 billion of interest payment because of the debt load. And for energy transfer, it paid at least 2.4 billion in this year. So it's significantly more than Kinder Morgan. And that's not counting the 1.3 billion additional money energy transfer has to borrow to close the funding gap. I should clarify here that the DCF numbers have already taken into account of the interest payment. So it does not enter the equation when we compare the DCF against the capital plus dividend. Taking a close look at the energy transfer, the cash outlay in next year will be much less than this year because of a much less capital expenditure planned in 2021. So 1.3 billion capital next year plus 3.3 dividend, that will give you 4.6. Voila, that's 4.6 is less than 5.4 cash generated. If we assume energy transfer will generate the same amount of DCF in next year as in this year. And keep in mind that in this year, the first half, the energy industry suffered a great setback because of the shutdown and a deep recession. So I believe it's fairly conservative to assume that its cash generated next year will at least as the same as the cash generated in this year, if not more. So what are the key risks? Obviously, energy transfer has a higher risk because of the funding gap, and also it's a high dividend yield. Indicates that the market also believes that it has a higher risk compared to Kinder Morgan. So what are the risks? So near term, the DCF in this year is insufficient to cover capital plus dividend, and it has to borrow with the already fairly high debt load. And it may suffer liquidity crunch if one of the several events happens. The first one is that if the financial system crashes and the energy transfer loses access to additional credit, which means lose ability to borrow. Considering that the Federal Reserve is pushing the gas pedal to the metal, it's unlikely that the funding mechanism will be shut down completely to energy transfer. Another risk is the energy transfer may suffer a major spill or other type of safety accidents, and which will lead into a lot of expense to clean up, to compensate, and also loss of revenue because it has to shut down the line that has a major leak or safety accident, which will lead to EBITDA reduction from current $10 billion forecast and impact the cash generated. Another risk is that if a large number of its customers go bankrupt, then they may ask the court to avoid their shipping commitment to energy transfer. For example, Chesapeake Energy entered into bankruptcy protection in this year, and it wanted the court to cancel its $300 million contract with the energy transfer. $300 million sounds like a lot. However, keep in mind that it's a spread over multiple years, and also it's a very small portion of the total revenue of energy transfer. So this risk will only materialize if a large number of customers go bankruptcy. Based on Energy Transfer's quarterly report, they reported that most of their customers have a very high credit rating, and for example, the utility companies, and also they are paid based on prior commitment. So even those customers don't ship gas through their pipeline or oil through their pipeline, they still have to pay for most of the customers. And another risk is that if energy transfer has to cut the dividend distribution by $1.3 billion to avoid the borrowing in this year, then its yield will drop from 19% to 12%, which is still very high, certainly higher than 9% currently you can enjoy from Kinder Morgan. So in my opinion, those short-term risks are manageable. Another short-term risk is that the Democrats may win both the White House and Congress in November, and the business tax rate will be expected to go back up to reverse the tax cut by the Trump administration and the Republican Congress. However, Energy Transfer as a MLP, which stands for Master Limited Partnership, hardly pay any income tax because of the corporate structure as an MLP. So it has a relatively small impact on the distribution ability of Energy Transfer. Also, the new White House and the Congress may ban flare or vent of associated gas, because currently a lot of small oil producers, especially, they burn gas that's as a byproduct of produced oil because it's expensive to ship the byproduct gas. However, the new Congress and the administration may ban those, and which will increase the demand for gathering system to ship the byproduct gas by the producers, which will be an upside opportunity for Energy Transfer to make additional money. Lastly, there is a short-term risk of the court may force Dakota Access Pipeline to shut down due to some disputes related to its environmental impact study and the subsequent permit to build a pipeline. The pipeline has been in operation, so it has been generating cash for Energy Transfer. Obviously, if it's shut down permanently, it will permanently diminish the ability of Energy Transfer to generate cash. So I didn't do deep research on this subject. However, Morningstar has done some research, and they presented their research result as if the Dakota Access Pipeline is shut down permanently, then Energy Transfer will suffer about $1 per unit value loss, which is regrettable, of course. Hardly change the high yield nature of Energy Transfer stock. In this case, it should be called a unit because of its MLP structure. There is a long-term risk, is that the society may have less demand for natural gas because of the drive to transition to a quote-unquote a green energy mix, renewable energy. So natural gas even is cleaner than coal and oil. It still generates greenhouse gas, and the society may shy away from using natural gas. And if that happens, then obviously there will be less demand in the future for natural gas, and which is a main product shipped by Energy Transfer, and that will make its assets less valuable. However, I believe that if that happens, that will take a long time. Given the current high yield or the money back by the Energy Transfer, the long-time horizon of this risk is more than offset by the short-term high yield. So let's wrap up the investment thesis. Comparing to ADCO, which is a very profitable business I like very much, Energy Transfer, the investment thesis is very simple. As a reminder, ADCO generates a lot of cash and reinvest the cash is generated to pay down its debt and to do merger and acquisitions, basically to grow its business. On the other hand, Energy Transfer will generate a lot of cash in next year and the year after. And the cash is now used to reinvest into its own business. It will be give back to the unit holders. So it's like show me the cash type of deal, which makes the analysis much simpler and comparing to the ADCO analysis. So basically, currently Energy Transfer has a very high yield at 19%, which is not sustainable. So it will likely come down either by cutting the dividend or by share price or unit price increase, or by both. So let's say it assume it cannot borrow money in this year, then it has to cut dividend by $1.3 billion from 3.3 billion to 2.1 billion in this year to avoid additional debt. Its yield will still be 12%, which is still extremely high. In 2021 and beyond, the DCF can comfortably cover existing dividend of 3.3 billion in each year plus capital investment needed because of a very large capital expenditure planned reduction. So I like it very much. I have bought about 0.8x times of Energy Transfer units. And to me, the definition of success for my investment is very simple. If the dividend payout can safely stay over $2 billion per year, it doesn't even have to stay at the 3.3 billion each year it currently pays out. It is still a very good business and will likely attract yield seekers given the extremely low interest environment created by the Fed. And even if the unit price does not increase, and I will just sit there and collect the 12 to 19% of dividend payment year after year, and that's still a very, very good investment. One more thing I want to mention is that as an MLP, the dividend payment has an implication in terms of an investor's tax return. For me, I will get K1 instead of 1099 dividend forms at the end of the year, and that requires a different income tax treatment. So if you happen to invest in an MLP, you need to keep that in mind. And for my case, I decided now to reinvest the dividend so that it'll make my tax filing life a little easier. Good luck. See you next time. Lastly, I want to reiterate that I'm not giving investment advices here. I'm just presenting my analysis results for documentation purpose as a part of my video blog of Quest for Twice. If you take any action after reviewing this material, you take the full responsibility for your actions.